Hi, in this video, we'll be looking at IFRS first time adoption. So guiding principles of IFRS adoptions. When a company adopting an IFRS, what kind of rules and regulations are the procedures they should follow? So IFRS 1 as a first time adoption of international financial reporting standards sets out the procedures that an entity must follow when it adopts IFRS for the first time as the basis for preparing its general purpose financial statement. An entity that conducts rate regulated activities and has recognized amount in its previous GAAP financial statements that meet the definition of regulatory deferral account balances can optionally apply IFRS 14 regulatory deferral accounts in addition to IFRS 1. Let's see. What does IFRS 1 require? The key principles of IFRS is full retrospective applications of all IFRS standards that are effective as of the closing balance sheet or reporting date of the first IFRS financial statement. Full retrospective adoption can be very challenging and burdensome. To ease this burden, IFRS 1 gives certain optional exemptions and certain mandatory exemptions from retrospective applications. IFRS 1 require identify the companies requires IFRS 1 requires companies to identify the first IFRS financial statements, prepare an opening balance sheet at the date of transition to IFRS, select accounting policies that comply with IFRS effective at the end of the first IFRS reporting period and apply those policies retrospective to all periods presented in the first IFRS financial statement. Apply mandatory exceptions to retrospective applications. Consider whether to apply any of the optional exemptions and retrospective applications. Make extensive disclosure to explain the transition to IFRS, including reconciliations from previous GAAP to IFRS to equity and total comprehensive income. Now let's see the opening balance sheet of IFRS. The IFRS balance sheet. The opening IFRS balance sheet is the starting point for all subsequent accounting under IFRS and is prepared at the date of transition, which is the beginning of the earliest period, for which full comparative information is presented and disclosed in accordance with IFRS. For example, preparing IFRS financial statement for the 2 years ending December 31st, 2001 would have transition date of January 1, 2000. This would also be the date of opening IFRS balance sheet. Therefore, as the opening balance sheet is required to be prepared and presented as a primary financial statement in accordance with the IFRS 1. The entity would present a balance sheet as of January 2000, December 31st, and December 31st, 2001. IFRS 1 require that the opening IFRS balance sheet include all the assets and liabilities that IFRS requires. Exclude any assets and liabilities that IFRS does not permit. And classifying all assets and liabilities and equity in accordance with IFRS. Measure all the items in accordance with IFRS. Be prepared and presented within an entity's first IFRS financial statement. Reconciliation of equity and total comprehensive income also to be done. And IFRS first time adoption, important key takeaways. The transition to IFRS can be a long and complicated process with many technical and accounting challenges to consider. Experience with companies adopting IFRS for the first time indicates There are some challenges that are consistently underestimated, including consideration of data gaps, preparation of the uh, opening IFRS balance sheet, and all of the related footnote disclosure may require the calculations and the collection of information that was not previously required under US GAAP or Indian GAAP. The company should plan their transition and identify the difference between the IFRS and Indian GAAP. Then the consolidation of additional entities. IFRS consolidation principles differ from those of Indian GAAP in certain respects, and those differences might cause some companies either to deconsolidate entities or to consolidate entities that were not consolidated under Indian GAAP or US GAAP. Subsidiaries that previously were excluded from the consolidated financial statements are to be consolidated as if they were first-time adopters on the same date as a parent company. Company also will have to consider the potential data gaps of investees to comply with IFRS informational and disclosure requirement. Then consideration of accounting policy choices. A number of IFRS standards allow companies to choose between alternative policies to be applied to the opening balance sheet and have full understanding of the implication to current and future periods. Companies should take this opportunity to evaluate their IFRS accounting policies with a clean sheet of paper mindset. This is the guidance in IAS. Accounting policies changes in estimates and errors does not apply to changes in accounting policies until after company presents its first set of financial statement and IFRS. Then regulatory consideration. In addition to the differences that arises between accounting standards, there may also be a local regulatory requirement to consider. For example, certain information is required by the ICAI but not by IFRS. Example, summary of historical data can still be presented in a part under Indian GAAP. However, such comparative information must be clearly labeled as not being prepared in accordance with IFRS. Thank you.